Good day, fellow investors, my fellow Canadian value investors. Didn't make a lot of videos for you, but here we go, the top 10 Canadian stocks for me to analyze. I've asked and I've got the list and we'll go through that list. Let's see what's there out there in Canada. Let's start immediately with Canadian natural resources. If I look at the chart, Canadian sands did well over the last decade or two, especially well since the pandemic as oil prices rebounded, things stabilized, and the businesses started scaling up. Good dividend yield, 5.67%, and now we have to see what kind of investment this is. Extremely large reserves, so plenty of oil to be produced over time. If you look at their distribution, they are the second largest natural gas production in Canada. Natural gas, heavy oil, light oil, so a little bit of mix there. Sometimes these things don't really get well priced. Distribution can also be an issue, but okay. For now, they have been doing really well. Significant shareholder returns, growth in production, increased the dividend, strong balance sheet, highly accretive acquisitions, all good. There is a good shareholder reward policy depending on the net debt and the free cash flow, total capital less dividends, and they are going to also reward shareholders. They're doing that, good dividend, and this is the most beautiful chart. You will see later in other stocks. This is nice. So they tell you, depending on oil prices, they tell you the free cash flow per share. So at 75, they make 5. At 85, they'll make 7. At 65, they'll make 3.5. At 60, they'll make 3. At 55, they'll make 1 or 2. Compare that to the stock price. All else equal, they should make now 2, which should be enough for the dividend depending on the debt levels. But on average, the key question is what will be the average price of oil going forward? Some say 60, some say 80. Temporarily, maybe it can go a little bit lower. Anyway, they have been doing really well over time, huge growth, and now even repurchases on top of dividends. The key question is, again, is it a good buy now? Is it a hold? I don't see anything wrong with this dividend. The only issue I have is the volatility of oil. The only key factor here is not the sands, the this, the that, the reserves, it's just oil prices. If oil prices are good, you can see the stock explodes. If oil prices don't look that good, the stock simply goes down. I didn't even know that oil is below 60, far from the 110, 120 of a few years ago, and you can see that is minus 50% from oil prices. Where will oil go? Where, if we would know that, then we would bet on oil prices, not on stocks. However, in a negative scenario, they would make, I don't know, $2 on 57. If it goes below, if it stays like that, then there will be a little bit less repurchases, but it seems that everyone thinks that this is just temporary low oil prices. Interest rates will go up, this might keep the stock higher, make it more interesting. However, when it comes to these oil stocks, in general, those are fairly priced. Nothing wrong with it, good dividend buybacks, a little bit of growth, production efficiency, this or that, all looks good. However, the situation isn't ugly now. It is okay, doing well, we are doing money, free cash flow, all good, some investments. Now, if oil goes to 40, it doesn't mean it will go to 40. I'm just discussing value investing, which is low risk, high reward. Now we are medium risk, medium reward. The dividend yield, the buybacks, it's a good reward, but there is still risk. A global recession, this or that, oversupply, who knows what. Oil prices always go up and down. So now you don't have a margin of safety. But if it goes lower, and this is the key, if oil stays lower, below 50, these guys don't make much money. However, if it goes to 40 just for a while, then lower supply, things stabilize, then it goes back to 100, then you make a lot of money on that upside here. So bad situation, good situation. And cycles are always like that. If you have low prices, then nobody produces, the result is high prices. If you get high prices, everyone produces, the result is low prices. That has been the standard here with the stock and with oil. And if I put it now on the quadrant, 5% yield, some buyback, some growth, so likely return around 7-8% with a little bit of risk due to oil prices. If oil prices go lower, then yes. The thing is that the higher the cost of production is with oil stocks, the higher you can expect the volatility with the stock. If oil goes below 40, these guys don't make money, it will look terrible, it will look ugly. If oil goes from now to 120, these guys will be flushed with money. And that is also the volatility you see here from 10 to 50, that's a 5x, and that is something to keep in mind. However, if oil prices persist for a while, a little bit lower, they have to cut the dividend, then you are down to 30-20 pretty quickly. That is the risk and reward that you don't have, for example, with these Norwegians that have lower production costs. That's the story. So nothing wrong, but also nothing great. You can enjoy the dividend. If it goes down, you double down. When it goes up again, you buy, you sell, or adjust your position. That's it. I wouldn't put half of my portfolio in it, but see how this fits you. Suncor Energy, again, same story there. Dividend a little bit lower, but you can see the volatility in this crazy stock. Thus, again, the risk is oil. Canada takeaway capacity is always an issue depending on the situation with the price, with capacity, things like that. The value proposition is the same there. Everybody in Canada has long life, advantaged assets, vertical integration, operations, all good. They're returning everything to shareholders, dividends, buybacks, yes, great, integration, doing okay, so production. You remember the previous slide of the other company, they just told me the cash flow per share, depending on oil prices, this is more standard, and then they say 200 million here, 200 million there, depending on one change in price, and then I have to calculate it. But that is, again, likely priced in already, and you can see here, the business environment is not 75, it is 57. So when things come back, this will not be 7 billion, this might be 4 billion. And then if I compare it to the market cap, we are at 6-7%, likely good for the dividend, but not much more. The stock I see higher and higher, but okay. There is significant risks over there, especially if things happen to oil. So when it comes to these businesses, one thing is for sure, you cannot expect stability. Many see the good dividend, this and that, but in a decade, there will be an extremely bad period. The last one was in 2020. I've seen them in 2015. Oil assets were terrible, 2009. But there will also be good times. That's the cyclicality of oil. I need to see the bottom of the oil price, rock bottom, capitulation, ugliness, and that might happen once in a decade. Happened in 2020, we did well, and I'll keep on looking for more. Now I can just tell you it's fairly priced, efficient market, okay, nothing wrong, but also nothing stellar. Now we go to Enbridge. Dividend, usually high debt, market cap 140 billion. Let's see what's going on there. And look at this article, 2018, two risks explain the valuation, because Enbridge was always cheap. It still is cheap now with a 5.66 yield. And with the dividends, okay, the total return over 7 years is a good one. So likely 10% per year dividend plus some price appreciation. And they are guiding for more growth, everything looks good. Not staggering growth, but good growth, 3% per share. They are doing their guidance, all good, reaffirmed guidance. Pipelines pretty stable there, depending on how much goes through there. But the issue always there is the debt. They are investing, diluting, in trying to find capital for growth. Fortunately, now there is a lot of interest from private equity, a lot of money flowing around. And you can see already here the increase in number of shares outstanding, which is then also changing. But the stock is going up. However, their debt is also going up. I would have thought here that they would work on lowering the debt a little bit. So all that growth is based on a 50% increase of debt. And that is, again, an issue. I never liked that much debt. If there is growth with debt, it means there is no growth. It's like the US government. They all say economy is growing at 2%. Wow, wow. But with 7% deficits, your economy is declining at 2% per year. It's just simple mathematics, no matter what everybody tells you. If I see here 50% growth in debt, and I don't see that reflected in higher than 50% dividend growth, then the story doesn't add up, which means the risks go higher. Nobody cares about the risk, and therefore it all looks good, but it is extremely risky. I hope nothing bad happens, but I wouldn't hold this. But again, keep in mind, if interest rates go lower, the debt burden becomes lower, things are good, this can go again up 50% with a good dividend. So don't come yelling to me, Sven, we loved you from Canada, now we never want to see you because you told us to sell Enbridge and now it's up to 2x. I'm just discussing the risk and reward, okay? Another pipeline, so oil and pipeline. Is there something else in Canada? But let's go. Everything good, expected dividend future growth. When I see 3 to 5% growth, that's usually stability in cash flows and everything is the largest risk one can find in investing. But okay, more secured capital, so how many pipelines are you going to build there? Nevertheless, we can see here 5% dividend here or there, but if I'm not correct, the yield of 10-year Canada is still 3.5. So you're not far, and this is no risk. That is a little bit risky. 5 times adjusted debt to adjusted EBITDA, that's a lot. 5% yield. Okay, again, another fairly priced when it comes to these things. And you can see here the ups and downs, dinga. Never know when something can happen. Regulation, pipeline here, pipeline there. Just too risky for just that 1-2% more than a bond would give you. Now, Canadian Pacific, Kansas City, we go lower on the dividends, 0.86, P ratio 23. The stock did great because it's a staggering great railroad that will just grow. Great logo here, but okay. Earnings doing well there, nothing wrong. The stock is doing great. They have some leverage, especially after the Southern acquisition. The outlook for the long term is high single-digit revenue growth, double-digit adjusted EPS growth, adjusted free cash flow, everything. I don't understand how can they grow that fast, that easy. And I always tell you, wait for bad times. This has a dividend yield of less than 1%. This is from 2016. A name, I don't know how known he is in Canada, Warren Buffett from Omaha. He bought Burlington Northern for 30-something billion in 2009. 1, 2, 3, 4, 5, 6, 7 years later, he already got 22 billion in dividends back to Berkshire. He bought Burlington at a 10% yield. You're buying this at a 1% yield. Wait for bad times to buy these cyclicals. If there is a recession, you don't need to always own things like that. You buy them, you make your money, and then you sell them. In good times, it is too good. You buy them in bad times. Sun Life Financial. I don't do financials, insurance. Charlie Munger told me that all these insurance businesses go bankrupt every 30 years. We have had bad times. Now it's a great time for insurance, which means bad times might. follow. Anyway, I'm not a specialist, so not for me. Okay, we have something interesting. Canada stock, the moon, is going there, just growing and growing. Dividend is even lower than 1%. The P ratio is 40, it must be something hot. And if I look at the numbers, this is growing at 10%. Now, growing at 10%, P ratio 40. Peter Lynch says that for it to be valued, the P ratio should be below the growth rate. So, okay, we can say it is in exuberant territory, but they are growing. And then the craziest thing, I've seen this already, this is a huge risk. When a retailer starts to go into Latin America and Australia, I've seen so many fail. Maybe they will manage and be successful, maybe not. Anyway, they are growing, comparable store sales is going okay, net new openings, further growth, capital expenditures okay, not too much debt, nothing looks bad, net income is growing, even if it has been stable. Now, let's discuss this. The P ratio is 40. Let me tell you how growth stocks are valued. The business is growing at 10% per year, everything looks great, P ratio at 40, if it just keeps on growing, good. Then you have the delta of the delta situation. If, for whatever reason, Trump invades Canada, whatever, who knows what your crazy southern neighbors might do. Who knows? Doesn't matter. It's a joke, of course, but you never know. And let's say there is just stability for 4 years. Already in year 2, people get scared. Thus, no growth. It's not a P ratio of 40, it's a P ratio of 15, 12. Perhaps just a little bit decline on earnings, just a small decline. So even the earnings go down a little bit. So you have a minus 66% on valuation, you have a minus, let's say 30% on declining earnings, and you find yourself minus 80%. This can happen like this, which is the key risk here. And I feel I'm going to be hated in Canada. I already know I can't set foot in the United States. Let me know in the comments if you will still take me in Canada. I really wish to visit. And at these prices, the growth with Dollarama needs to continue forever. Who selected these stocks? You really want me to be hated in Canada, huh? Brookfield Infrastructure Partners. Oh, baby. Okay, let's go. This has to double. This is now cheap. This has to double. They pay a dividend. Okay, let's see what they are doing. Looked a little bit. They just had an investor day just for me now. And slide number 4, we grow 10% per year. This is even better than Dollarama. Deploy capital at 12 to 15% target returns. We are in a private equity, everything bubble. We just discussed the maximum I can get with risky plays is a 5% yield. These guys invest with 12 to 15%. How? But okay, capital recycling, I have to deepen on that, I have to learn how to do that, and maintaining a strong financial position, as long as the debt markets are open. But for now, things have been great, they are growing at 14%, 9% distribution increases, everything looks great. Backlog is a 4x backlog, which means they will even grow faster, and they just are buying things. Colonial Pipeline, all good, capital recycling, nothing wrong there. And they are buying at 9 times EBITDA. Okay, borrowing, buying, they are putting 500 million their own equity, other investments, pension funds and equity, all good. Then, they're also knowing that they can predict the economy. Warren Buffett said he cannot know where interest rates will go. They know where we'll go, so that will be a positive, that will be a positive, that will be a positive. All good for them, and that's not 10 years. Sven, 10% per year is boring. Let's go to 14% per year. There are great deals everywhere, especially these deals that are cash flows, 12 to 15%. You just go, I have $1 billion, give me some deals, and I'm such a genius. Look at this. 350 billion because there are no deals. Who I'm going to trust? Don't get offended, Canada, but these private equity vehicles cannot be set up in the States. That's why Brookfield is set in Canada, and the former entities were set in Australia before going bankrupt in 2009. But if there are these 12 to 15% deals, is Buffett really that old? Greg Abel playing too much bridge with Buffett and they are sitting on 350 billion? Who knows? Isn't Greg Abel Canadian? Who knows? They are the go-to grow utility. They do things magically. And then I look at the assets, 100 billion in assets, everything is growing. And then here, okay, here I look the liabilities, 74 billion, partnership capital, 29 billion, but interest in others of operating subsidiaries, 20. Okay, so there is 9 billion of capital on the 100. So no matter whether it's leverage or not, it is pretty levered. The interest expense is, what is that? 15% of revenue, or if we take direct operating costs away, I'm at 6 billion, more than 60% of operating costs is interest expense. So any change in this, if profits go down, interest rates go up, that's it, but okay. Net income, minority, and what is left for the limited partners is peanuts. I don't know how they are valuing things. I don't know if they include this. You just look at an asset, oh, this is worth 2 billion, let's say it's worth 3 billion, and revalue everything. They do their thing. I'm not as smart as there, but I see a lot of debt. I look at the cash from operating activities, which means that just operating activities, net income, okay, they are capex spending more, some will be for investments, but it is a very, very tightly traded situation. And look at this, cash from operating activities 4.6 billion. If I look at the assets, total liabilities, total assets, which means that the return on their assets is 4%. 4%, and they are speaking about 12-15%, which means this is financial engineering. It works great until it doesn't. And then I ask AI, 7.3 is the cost of debt. Okay, I looked a little bit, there are thousands of shares, types of shares, this and this. I feel it is a house of cards, but I simply can't help because I gain nothing from spending my time in this. You read the 400-page annual report and see whether this is really built to last or if there is risk. That's my message. If it wouldn't be risky, Warren Buffett would be in it. That's the story. Do you hate me enough? Topicus. Software in Europe, P ratio 66, now down. Let's see, IPO from Constellation, so must be good. They are doing these softwares in Europe, everything is going good. Revenue 20%, 5% organic growth. Okay, Constellation software is also down like Topicus. The scary thing is whether there will be AI impacts. They are growing 50, okay, this was special, but they are growing 15, 20%, now 10%, a little bit organic, this and that. Earnings are doing okay, but there is again this minority part, so 127, 9% margin. This is euros, Canadian dollar. So yes, the P ratio is 66. For them to justify this, they need to grow 2x for the next 9 years to get to somewhere where there will be bigger competition, bigger this, bigger that. And that is again the story there with growth stocks. And the stock will behave similarly. If there is more growth than expected, the stock will go up. If there is less than expected, the stock will go down. What will happen in Europe with spending, with this and that? What will happen in Europe with AI, free cash flow, growth for sure? What will be the impact? Even there was just Constellation Software discussing the AI impact. We'll see what it will bring, and that is again a risk. It might trigger a massive oversupply of programmers, but it will lead also to improvements. How it will look like, nobody knows. Risky business. The stock can go anywhere, so don't kill the messenger. Magna International from better to worse. Auto parts now, they did well in the past. Okay, the assumptions are still for stable, little bit declining production, but outlook, okay, stable. However, I just did Stellantis, and again, this is something that I found from Zimmerman. He was vice president at Ford in 2007, and he said this: a severe recession year is 13 million units, so a drop from 15 million to 13 million, a little over 15%, is really the difference between decent performance and severe losses with a lot of job reallocation and destruction. And you can see it here, and you can see it here. That's when you want to look at these cyclical businesses. Now, it hasn't happened yet. The company isn't really growing. There is potential, but okay, highly competitive. Give it a recession that we haven't seen in 15 years, and then again come back to these businesses. And then find the best you can find. The conclusion on Canada, I hope Canadians don't hate me. It looks okay, but just not now. 5% utility, growth bets, everything has this huge recession risk if we ever get to a bad recession. If we don't, if they keep on printing money, lowering rates, everything, okay, you keep on doing your 5, 6, 7, 10% per year, and who cares? That's the risk and reward. I can't predict things. I know that we haven't had a severe recession since 2010. This is Canada. Here we have recession columns. So that's a long time without a recession. Relatively, these businesses might be okay, but we are absolute investors, and I simply prefer better things. These three, and there is also other on my research platform, are better, I think. Amsterdam Commodities, niche business, food business, that's defensive, 8% earnings growth, 5% dividend yield. It's a little bit higher now, but it's spices and things like that you can't really invent much around. I would put the Canadian natural businesses somewhere here, risky and dependent on recessions. I hope you don't kill me if I set foot on the Canadian land. I'm really looking forward to visit, so I have some invitations, so you never know. Send me better things and then I might look at it. Thanks for watching. I'll see you in the next video.